What is up, guys? It is Pace Around Your Grandpa's Yard and talk about macroeconomics hour. So this has been a fucking wild week. Just like, it's unprecedented and there's so many things going on, and I have something that I want to talk to you guys about because it's crazy and it's really just dawning on me this week. So if you look at all of the things that are happening right now, what are the big things, right? We got inflation. So we got inflation, and everyone needs to keep inflation down. If you have been living under a rock, you have not been watching J-Pal, I'm sure most of you guys have been seeing all the stuff with the federal funds rate. If you have a stock portfolio, you're watching it go down because they're pushing on it. And what's happening right now is you've got the federal funds rate is probably going to increase by a half percentage point. It could even increase by 75 basis points, which is 0.75%. Just to make this super, super simple, the federal funds rate is something that is used by the government in order to control the flow of funds. And if they control the flow of funds, they control liquidity in the marketplace, which is just a really short answer for they control how hot or not hot the economy gets. So by increasing more money into the system, you are then making a hotter economy, which is why we have inflation. And then by decreasing and doing what they're doing right now with rug pulling, they are increasing the federal funds rate, which makes things like APRs on credit cards more expensive. It makes all these different loan types more expensive. And then on the other side, you've got the 10-year treasury. So the 10-year treasury is done by bond traders. The yields are done by bond traders. And I'm gonna try and put this simply, but essentially because the government is saying, hey, we're gonna increase the federal funds rate to 3%, the traders are all getting ahead of themselves and they're pushing up the 10-year treasury up to 3%. So just to give you some basics on that, when the 10-year treasury goes up to 3%, how banks make their money is they put another 2% on that and then they loan it out and they make a 2% spread. So if a 10-year treasury is 3%, then they're taking that, they're loaning it out for a 5% loan, which is why we're seeing 5 and 5.5% interest rate loans right now. And it's making housing prices incredibly unaffordable. And here's the beautiful thing. And there's multiple components to this. So the thing that I think is happening that the government is doing is the government doesn't want to pay more money. They don't want to pay more money because that's expensive. And so when they increase the federal funds rate, when they sell bonds to other countries, they have to pay a higher interest rate. So think about it this way. If I loaned you $1 million and I was like, hey, I'll pay you 1% per year, and that's whatever, that's 10 grand per year, right? So 10 grand per year, I can tolerate that, that's chill. But if all of a sudden you go up to 5% and I have to pay you 50 grand a year on that interest payment, that hits you in the pockets. And so the government's going through that right now, and they're like, they're going through this exercise, which you always follow self-interest. You always follow self-interest on how other people make money, and that's how you can delegate your decisions. So an example is the government is saying, hey, listen, I don't want to pay more money to these other countries, but at the same time, I have a fiduciary duty to the citizens of the United States in order to decrease inflation, because inflation sucks. It's really hard when all of a sudden gasoline is at $5.85 and you can't buy anything and housing prices are through the roof, and now housing costs are through the roof because mortgage rates are up. And so here's the beautiful thing. So what the government does is they say, hey, we're gonna go to 3% because they need to drop aggregate demand so they can have everyone get off their back so they can be like, oh, inflation's coming down, don't stress, guys. So what they're gonna do is they're telegraphing and saying that they are going to increase these rates. And then by saying that, bond traders push it up. So they push up the yield. And then from there, housing prices are more expensive. And then when housing prices are more expensive, what happens? Then people step away from the housing market and the housing prices will drop. And when housing prices drop, that's where most of people's net worth is in. So the way that you decrease aggregate demand, which decreases inflation, is by people spending less money. And people only spend less money when they feel poor. And how do they feel poor? When their investments go down in value, when they lose their job, or when their house prices go down, right? So we've got one catalyst. Catalyst number one, stocks are down. We got 10%, that's not enough for anyone to feel poor, especially if you made 30% last year, so you're just chilling. Most people just made a boatload of money last year, so 10% is not enough to do it. But what will do it is in 3 months, if we stay at the if we stay at the mortgage rates of 6%, we are absolutely going to watch a drop in housing because it's just basic math, right? Like if you're looking at this, you're gonna say, okay, a person had a house mortgage, a $500,000 house for 3%, you know, $2,300, and that was a year ago, right? That was 90 days ago, 3%. And then now, if you have a credit score in between 680 and 700, that means that you now pay a 7.125%. 7.125% mortgage rate, which means your payment just went from $2,300 to $3,300. And everyone's like, oh, it's okay, you know, housing prices will still go up because blah, 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 inflation. I'm like, that's not possible. Did people start making 43% more money in the past 90 days? That's a resounding fuck no, just a resounding fuck no. And so people don't like, analysts are incredibly bad at predicting when things are gonna go bad because no one in human nature wants to predict things going south. And what they're gonna do right now is the government is trying to front run the system because they don't wanna pay more to other countries. So they're taking a shot. They are literally targeting straight at the housing market in order to drop those values. And people have made enough money, so it's gonna be fine. And they don't wanna cause a housing crisis, which they can always pull back at any minute, right? And say, hey, you know, we're not gonna do this. We're not gonna do 3%. We're only gonna do 2%. And the mortgage rates will go down. But right now, I can tell you that the federal, like the central bank is targeting the housing market. They're going straight after it. They are going to drop housing prices. Anyone that says that you don't believe that housing prices are gonna drop, you can just punch me in the face if I'm wrong on this, but I'm not wrong. Like we're gonna watch a 5 to 10% decrease in housing prices at least as long as interest rates stay. If they drop, obviously it won't drop. But if it stays at 6%, we are definitely watching a housing correction and it's coming. And so everyone just needs to buckle up and get ready because we're gonna watch that happen. And then once those catalysts start, it keeps moving, right? So it's gonna go housing. You got stock market getting quaky. You have now big names that are starting to drop. Before it was like, you know, you had these companies that didn't have earnings. Let's say you had like Pinterest, you had Shopify, or things with really high PE ratios. So of course those are gonna get hit harder. But now you're getting to the point where Google's dropping. You know, it dropped 4% today. And this is a super stellar company that has massive moats in the market. And so they've just, you know, this company is as monopolistic as you could get, and they're still taking hits in the market. So now you're watching big mega cap companies come down. So you got small caps were the first catalyst. Second is you have mega caps. The third is you're gonna start watching softening in the demand in housing. And it's gonna happen fast. Just watch. It's not gonna happen right away because you got the FOMO people that sold their company, they have $1 million, they wanna spend it. But ultimately, what's going to happen is normal people that have to pay everyday bills are gonna be like, yo, a $3,300 payment versus a $2,300 payment. I can't swing it. That's not possible. You get like another full-time job, that's crazy. So we're gonna watch things change. It's gonna change fast. And so I think that patience is key. Patience is gonna be absolute key this year. It's super hard to watch things run away from you, right? I hate the fact that I'm looking at trying to buy a house right now and I'm just watching mortgage rates run away, and that's where FOMO comes in, and that's where people make terrible decisions. We are pack animals. Human beings are pack animals. And so we need to understand that that is in our very nature and our very biology. So we run where the pack goes. Sometimes that's good for us and we go towards safety. Sometimes it's horrible for us because we run directly into harm's way. And this is an example of that. So I would just say patience with everything, patience with investing, patience with trying to buy housing and buy investment properties, and just really just watch the market right now. Just really, really stay close to it and try to not get your emotions involved and just let data be your guide, because you're gonna have a bunch of shock jock people saying a bunch of stuff online, just trying to get everyone riled up. And we just need to look at the data. You know, price to income ratio for housing is the highest level since 2007. If you look at the price to income ratio, it's higher than 2007, and that's at a 6% interest rate, which was the same thing. There's no way. So we have some very tumultuous times coming ahead, probably in the next 6 to 12 months. And I think it's really important for people to be in the best financial position that they can, be as patient as they can, focus on your skill sets, focus on your side hustles, make sure that you're gearing up, because the market has been so good for 12 years, you know? It has been so good since the Great Recession, and a lot of people have saved up a lot of money. So just be smart with that, because you work super hard for this moment, and just know that like we can make it through the other side of anything, and we will, but skill sets, side hustles, no one can ever take that away from you. They can never take away your skill set. And capital can come and go, but you just want to focus on the things that no one can take away from you, continue to build, and we'll go from there. So thank you guys for watching. Sorry, I just popped off really fast, but I'm just seeing so many things in the market. It's a really interesting time. So leave a comment, let me know what you guys think. If you think I'm full of shit, let me know, because I want to keep learning as well. So I will talk to all you guys soon, and have a happy Friday.